Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Aabha Bakaya, and our guest on the show today is Aditya Narain, Managing Director and Head of Research, Institutional Equity at Edelweiss. Aditya, very good to see you after a long time, and thanks for joining in. Let me begin by asking you about the regime for the market right now. Do you belong to the camp which thinks that this is just a pullback in an otherwise bullish kind of cycle? Or do you believe that we are actually in the middle of a bear market, however long it turns out to be?
So, I wouldn't necessarily take either ends of it, but I do think it's not just a pullback. It's just not a market phenomenon, which is a pullback after a strong rally. I do believe that the economics have got stretched a little bit at this point in time, given what inflation has done. And so I would be watchful over the next couple of months to see the extent of damage that this inflationary run effectively does. And, inflation is one part. The other bit is the policy response that you get, which is a corollary of it. But the reality is that rates have gone up. There's been a certain amount of price intervention, and that tends to dislocate the mood a little bit. So, specifically to your question, is it a bear market or is it just a break? I'd say we have to sit back and watch a little bit. I think markets clearly continue to be at a little bit of risk, but to an equivalent amount, the economy also seems to be at a little bit of risk. So I think it's somewhere in between there.
Given the risks that you highlight, Aditya, do you think that it is possible? I mean, this is the question one keeps coming back to, because last 2 years we've got used to the market trading at valuation levels which are way above or quite a bit above the average multiples, the mean multiples that India has traditionally traded at. So given the new risks which have come to the fore, is it conceivable that we go back to trading at if not lower, then at least the mean multiples of the last 10 or 20 years? Because that too in itself would entail a 10-15% correction from even current levels.
Yeah, so I look at it in two frameworks. One, is it possible in terms of us getting back to lower levels of lower average multiples? Yes. I think the other element which is important to look at is whether fundamentally our premium or our valuation framework relative to other emerging markets, whether that's pushed up a little bit. And I'd say on the latter bit, I do believe a little bit of that has happened simply because there has been a little bit of a breakdown, not necessarily economics, but there has been a little bit of a breakdown in other key emerging markets, right? So in a relative context, India is probably a little better placed than it was vis-a-vis other emerging markets at this point in time. But at an absolute level, you're absolutely right. You do have risks in terms of multiples coming off a little bit. Now, what I do believe is that, one out of two risks will play out. Either economic slows a little bit, earnings slows a little bit, and so, the market comes off on the back of that, or multiples come off. I'd be surprised if you get a combination of multiples contracting and earnings contracting. I wouldn't play for that scenario, which is obviously very negative from here. I'd say you're probably still a little bit somewhere in between. But what has structurally changed is that within the EM basket, you are at actually more of an operating premium than you have been. From an economic trajectory perspective, you've not seen inflation like this for a fairly long period of time. And I think the damage it could do is still something that needs to be watched for, rather than glossed over as could be the case in a bunch of bullish camps.
This is an interesting point, Aditya, because it leads me to my next question, which is the kind of earnings disappointment we could be staring at. Last 2 years, we've only seen earnings upgrades from brokerages like you. But now, given what is going on in the world of commodities, which was a big contributor to these earnings upgrades, is it possible that we now begin to see earnings cuts coming in over the next few quarters, which is something the market had not seen for the last couple of years?
Yeah, so simplistically, yes. If you see our numbers in the recent quarter that reported, that's resulted in a net cut of about 2%. But it's as like you were saying, it's been hugely supported by commodities. If you were to strip out the commodity support, that number is actually much, much deeper. So to start with, you're absolutely right. I think the risks of downgrades at the aggregate level is actually reasonably high. at the broad level also is high, simply because you had a couple of standouts at this point in time. So I think that's one element of it. And that's why you're seeing, the market might be up a little bit in the recent past, but there is a certain amount of caginess or wariness in the market as it exists at this point in time. That's one element. I think the other element of earnings has been that what has been where people have, X of the commodity and the banks, right, which run a different cycle, right? But X of that, I think a lot of caution has been in terms of earnings getting cut because of margins, right? And you've seen some of that play through. But I actually believe the bigger risk and the less stated risk is what you could see in terms of demand being a little weaker. And I would suspect that would be the surprise element in terms of earnings downgrades, if there were to be significant downgrades, rather than the shock of commodities and prices, which has generally been tending to play through.
Aditya, what's looking exciting to you now that valuations have moderated somewhat across the board, whether it be on those new age companies, whether it be on financials? Where would you be cherry picking?
So I think we have a couple of buckets where we are more comfortable. One is the financials. I think the big thing that in spite of the erosion on the economic side, asset quality has stayed very, very comfortable. I think that's a space where you get reasonable valuations and you get balance sheets in reasonable shape. So I think that's one space that we kind of like. The other space that we actually like is the two-wheeler space. This is slightly contrarian in the face of rising fuel and in the face of commodity prices. But I think the reality is that's where valuations have been beaten down very, very reasonably substantially. Expectations are fundamentally very, very low. And so you're getting to buy good companies at cheap prices with no growth expectations. And if you're generally defensive on the market like we are, I think that's where you can get a little bit of upside. And the third space is really, quite honestly, the energy space, which might be quasi commodity and so to some extent a little vulnerable. But we actually tend to believe that the whole primary oil and the and the refining that goes with it, I think that has seen a little bit of a structural uptick, or you're going to have a couple of years of shortages there, which even if you don't get the margins that they are at this point in time, could support you for an extended period of time. So I'd say these are the three places that we would want to more than dip our toes in, which is the banks, two-wheelers, and energy. Generally speaking, we'd want to stay away from the cyclicals, given that I think the risks to growth are reasonably high at this point in time.
In previous cycles of volatility, Aditya, we had this curious phenomenon of stocks which were very expensive but which had a measure of growth actually being a very narrow subset which did outperform the market in a major way. We've seen just pre-COVID those sets of stocks, 15 or 20 stocks, growth at any price, they were called, and I mean they could do no wrong while the rest of the market languished. Where do these stocks fit into your framework right now, where consumer demand is tricky, interest rates are rising, and but there is a stability factor associated with those names? How do you see these doing now?
So I think just to go back, I think when they did well, which is pre-COVID, growth at any price was one element of it, but I think the bigger element really was safety, because you had a macro and an underlying economic environment that was fundamentally slowing, and it was kind of unsettled, whether it was asset quality or other issues, right? So I think they did well in the context of growth at any price, but more importantly, because you were not ready to take anything else because of the apparent risks in the system, right? And you were looking at an economy where you were basically fundamentally playing for safety, right, rather than for growth. I think this cycle, right, for all the caution I mentioned over the nearer term in terms of inflation and otherwise, I think this cycle is poised a little differently, which is it's hard to make that call on when growth will pick up, whether it is capex, whether it is demand, and what can be the risks of inflation. But I do think that between balance sheets being in good shape, whether banks or corporates, whether a certain amount of risk appetite being there in the market, I do think that you're at the earlier stages of a longer economic cycle. If that is the case, right, then you will typically end up seeing risk appetite going for stocks which could grow rapidly rather than grow moderately. And in that context, I'd say these stocks will potentially be laggards in the more medium-term scheme of things. In the immediate, they might still provide you a certain amount of cushion simply because there are immediate demand uncertainties. But from a longer term, I think the willingness to pay up so much for these stocks will be relatively less than it has been in the past.
Fair point, Aditya. And let me ask you this, because this whole premise of this cycle that you spoke about is that this is a new market regime where there is some capex recovery, there is demand recovery, and we will see a protracted earnings cycle. Do you see any of the risks that we started discussing at the start of this chat, any of them actually derailing this cycle? Because a cycle plays out over some years, and there are risks which are quite macro in nature at this point. Could they begin to come in the way of fleshing out of this cycle? The capex cycle does not happen?
Yeah. So I'd say there are two risks. One is in this entire cycle getting delayed because of what we are seeing at this point in time. I've spoken reasonably extensively on this, right? And this could be much more extended than a quarter or two. So I think that's one primary risk as far as this cycle is concerned. I think the other risk, which is much more real, which will probably play through, is that parts of the market might be extrapolating a very vicious upcycle, right? And the typical benchmarking of what you saw between 2002 and 2006 or 2008. I think even if this plays out as a lot of people are hoping, and we're also suggesting could well play out, it's going to be a much slower cycle. It's not going to be as vicious. It's not going to be as virtuous. And from the perspective of businesses, it's going to be much more disciplined. So I think the risk lies that people extrapolate the momentum, right, or the magnitude of this cycle rather than anything else, rather than it being a question of whether it plays out or not. I'd say the risks are it gets delayed, and the risks are it's a decent cycle, it's a long cycle, but it's a moderate cycle, not an overexcited or an overly excitable cycle, which market folks tend to will on very often.
Aditya, do you feel we're perhaps, while we're watching and waiting and there are some of these risk factors, but do you think for the most part, perhaps, we could say that we're close to the end of or peaking in terms of inflation? Would it be safe to say the worst may be over, or do you still feel that the next couple of quarters are going to be very, very important to watch?
So I'd say in terms of inflation rising, right, that upspike that you're tending to see, the worst is potentially over, right? But that doesn't mean it is going to come off, right? And I think that is going to be the challenge. That is where the extended risk lies. And the fact that inflation is actually pretty broad-based suggests that that's where the pain element will lie, right? If there is someone, I think, taking the call that it's a couple of months and this thing starts falling off, and so we should be positioning ourselves for that, I'd say that's an overly optimistic perspective. If the call is it's not going to go very much higher, but it's here to stay for a period of time, I'd say that's more the call. And most importantly, the thing that you need to watch out for is on whether this starts damaging growth much more than is being anticipated at this point in time. Because quite honestly, if you see the quarter results that have gone by, it's hurt a little bit, but it's not been damaging, as it were. I think the risks with inflation at the levels it is at this point in time is that it could be damaging, right? And quite honestly, the response is not necessarily the pure earnings response that we very often try and look at. The response very often is the policy response, which can undermine things. And you've seen that between rate hikes, which are at some stage not expected, between some stuff on steel, a little bit in terms of exports restrictions. I think that tends to linger a little bit and is not great for markets. So specifically, is it going to fall off quickly? I'd be surprised. Is the damage already done and past? I'm not so sure. Is it going to get worse? I don't think so.
Let me ask you about a couple of sectors then, Aditya, because sectors which we haven't touched upon in this chat. One is cement. Last few days, cement stocks have been battered quite a bit because of how the terrain for the sector might look post the Adani Holcim deal. Have you reassessed prospects for the sector in the light of this deal?
Yeah, so we have been, kind of neutral on the space, but we do believe that this mix of an aggressive player, right, and an aggressive capacity response that you're seeing from the incumbents, right, I think that is something that is not great for the sector as such. It will weigh on the sector. And you can sometimes brush this aside when you have a demand call or a demand look, or a demand supply mismatch, which is favorable. I don't think you have any of that. A lot of that is exposed to the fact that the economy is probably going to slow a little bit in the near term. And so to that extent, we would generally tend to be a little cautious on the sector. I'm not sure if you're going to necessarily lose too much money, because remember, it is also tending to consolidate. But I think it's going to be difficult making money in this space.
One question about what you're hearing from companies, Aditya, because it's such a strange time. Globally, there is so much volatility. There is uncertainty about whether the world is heading towards close to recession, if not a full-fledged recession. And we are talking about a capex cycle fleshing out in the middle of this kind of uncertainty. Do you hear from companies a lot of confidence that they want to go ahead with capex planned earlier, or could it be a time of introspection or reassessment or being wary as well?
So let me put it this way. I don't think there has been a massive bottom-up capex build or expectation pullout over the last couple of quarters, pre all these issues in any case, right? I think what you were tending to see was a confident and a measured approach where people were talking about brownfields, maybe the odd greenfields, but I think there were very, very few people who were really going overboard or overly excited, right? In that context, I don't think too much has changed, right? Because there were specific plans, there were nearer term plans, and none of them were very aggressive plans. So I think a lot of that remains on board to start with, right? Secondly, I think a lot of the recession talk that all of us are a part of, it's more a market commentary, right, and a market expectation rather than anything that businesses on the ground are seeing, right? Whether it is the commodities players, whether it is the technology companies. So to some extent, I think as commentators, we get a little carried away. The market tends to look at it very seriously. But I don't think that sense has percolated down to businesses. That said, when you're facing this specter of such commentary, I think the capacity and the willingness of businesses to commit to stuff which is, not underway or very specifically on the drawing board, I think that capacity is limited. So I'd be surprised over the next couple of quarters, you see announcements of people talking about capacities in 2025 and 2028. So I think it's going to be what is in your books or what is on the drawing board. I think that continues. Let me be clear. I don't think it's a space where anyone has talked about pulling back on anything that is specifically on the anvil, right? It's just that looking beyond, I suspect there's a certain amount of caution that is coming through, but it is quite honestly very market driven. I mean, you haven't seen any data that suggests the US is in recession. So it's as I said, market commentary, which is where people are wary, and so stuff that's not on the drawing board will not come on, but that stuff that's on the drawing board will stay on. Is how I see it at this point in time.
Aditya, would you then suggest one sticks with especially for a lot of these younger, newer investors that have gotten into the market at the higher levels? Would you suggest they stick with quality names? Would you say perhaps some amount of experimentation in the broader market is all right at a time like this? What would be your advice?
Yeah, so I mean, at some level, perspectives tend to focus more on on professional investors, right? But what I'd say is that yes, you need to be a little cautious over the next couple of months. If you're investing with your talk, which is normally long term, then you're kind of okay. If it is very short term, then I think you should be a little bit more quality biased rather than try and make too much money in the short term.
All right. Aditya, we leave it there. Thank you so much for joining us on the show today. Great chatting with you and look forward to speaking with you again here on Business Today.
Super to meet up again, Udayan.
If you like the video, do like, comment, share and subscribe.